Well, Happy New Year, everyone. Just for future informational purposes, this is being filmed mid-January of 2022. David Moore with Equity Advantage, 1031exchange.com, and I'm blessed to start the year off with my buddy Robert Smith of Peregrine Private Capital, and Bob's looking sharp as always. I'm looking a little bit sloppy, but we're not in California shirts today. Not like California shirt means anything. They're being flooded down there, but hey, we try to present information that's going to be useful for everyone out there. If you've got questions on something you have not seen us cover, please don't hesitate to reach out to Seymour at 1031exchange.com, Seymour at 1031exchange.com, and we're happy to create some content on something you may have questions on. But Bob, going into 2022, it's a pretty turbulent period of time, not just in weather, but in the economic world as well. And I'd sort of like to hear your thoughts on stuff. But before I get to hear your thoughts on that, I just sort of would like to know, I don't think our audience has ever really heard how you ended up in the real estate space. And you were working in financial services, but not a lot of those people move from financial services into real estate, from Wall Street to real estate. Why did you do that? When did you do that? And what's been the result of all that?
Good question, David. And you are the master of understatement in terms of change. Our transition into real estate, having been in the financial services industry for over 35 years, transition into real estate was really prompted more than anything else by the desire to find something that was tangible, and whose principal component was income, because income, at least to me personally, is real. It's something that you see every month or month in, month out, and it's in a normal environment, and we're certainly not coming out of a normal environment over a decade worth of near zero interest rates, for which there is no historical precedent in the 4,000-year history of money, but in a more normal environment where inflated valuations are not rampant, income is a very, very, very important part of total return. And so we like the fact that real estate is it's tangible, it's substantive. I mean, it's really it's really the antithesis of cryptocurrency, FTX, all that kind of stuff, and seeing that coming over the last decade, again, in terms of a historically anomalous environment where money was free, and so you could throw an infinite amount of money at companies, people, and ideas that lose money because it has no valuation. We did not believe in many of those products or subsequent overvaluations. So we were looking for something that was real, tangible, substantive, that would do well day in, day out when the economy's up, down, or sideways. And more often than not, I think good quality income producing real estate, particularly if it's an operating asset, meaning an asset that's habitational, multifamily, senior living, manufactured housing, self-storage. Self-storage is kind of an offshoot of habitational assets. Got to have someplace to place your stuff. I mean, that's for real. It doesn't go away. I mean, does it go up and down? Certainly. There's cyclicality to the valuations, but those cycles tend not to be as dramatic as what you see in the ordinary financial marketplace. And when you factor in the component of cash flow, it has a very stabilizing effect. And being in it for the long term, that's what attracted us to securitized commercial real estate to begin with as a specialty.
So one of the knocks Wall Street always has on real estate is it's not liquid, so they look at it as sort of a problem. I look at it as a solution, really, because it sort of takes the whoop-de-doos out of it, right? I mean, if I look at our IRA business, IRA 401k business, people come to us ultimately to diversify out of Wall Street's offerings. And really, it's, any financial advisor is going to say diversification is the secret of success, right? But if you look at the objections, it's typically the lack of liquidity. It might be the objection to, using IRA 401k funds to go buy real estate because you lose interest deductions, depreciation, that type of stuff. But I look at, you've heard me say it before, 1031 is sort of just the IRA for real estate. And I grew up, in a real estate family, and I was mentored by obviously real estate people, and that's what I believe in. And I joke about my position on retirement accounts a lot of times. I'm not a huge fan of them, even though I sell them, just because I like real estate. So if I buy a piece of property with my retirement account, I lose those interest deductions, depreciation, all that. But I mean, to use that argument against diversifying with those qualified funds in the real estate is sort of a pointless statement, because nothing you can buy with a retirement account is going to give you those things anyway. But all of those things, when you pull money out of your pocket with that real estate, I was taught never to bank on appreciation. You know that. We've discussed that many times. I was taught to answer 3 questions before I buy the property. What am I going to make? When am I going to make it? How am I going to make it? If I can't answer the questions, don't buy it. You're selling things that are a little bit different than just going out and buy a property, because that buyer is not the person that's going to be on the hook to manage those assets, which a lot of our clients these days are really refugees from rent control. I mean, they can't afford to deal with the properties anymore. Right?
That's a good turn of phrase.
So
refugees from rent.
Yeah, and I was watching the news this morning, and they were talking about these real nice hotels in New York that they're being forced to take these homeless people, and it would be one thing if the homeless people were appreciating what was being given them, but they're not doing that. So I think you look at real estate, and the things I love about it is you don't have to bank on it appreciating. It's going to give you cash flow, interest deductions, depreciation if it's money out of your pocket, regardless of what it's doing. I was really curious, from a Wall Street guy with and that's what you were at one point, making that transition into, I'll say the dark side, the real estate world. But you made, very few people that I know, and I think I first met you at the racetrack in the probably the mid '90s. Cars, not horses. Maybe cars with horses on the side, but anyway, and we met because we had common friends in the tax community, and they had introduced us at that point in time. But I remember, I think the first time you asked me to speak was probably the mid-late '90s, and we were talking about at that point probably institutional tenancy and common stuff. But to have somebody from the financial, the Wall Street world actually take that leap into really, and you went all into the real estate space, that was a big jump for anybody at that time, and it's worked well for you through the years. And I think, if we're looking at our current situation, I'm going to use the R word. I think people are finally acknowledging we might be in a recession or headed that way. I think that the real estate hard assets is where you always see a flight to quality in those times. And I just wanted the audience to understand a little bit why you made that jump and how you did it.
We made the jump because, in my humble opinion, Wall Street's binary. Wall Street makes money buying and selling things. Whether that asset goes up or down or sideways is really a secondary concern. That's how Wall Street generates a huge trail or train of money by buying and selling things. And that's one of the reasons why Wall Street has historically been, I believe, antipathetic to real estate, because income-producing real estate, if it's doing what it's supposed to do, doesn't change, okay? Meaning it provides monthly income, oftentimes tax-advantaged income stream, and given the right thing in the right place at the right time, it may also appreciate as well. So it stays put, and Wall Street considers that dead money. And Wall Street doesn't like dead money because it can't make money buying or selling it. And I never liked that. Well, we thought that was really mercenary, and I'm not particularly good at trading, buying and selling things, but I think we're good at finding long-term valuation for people and stable sources of income, and that's what real estate does. It's how we initially transitioned into the REIT world, non-traded REIT world, and then helped create subsequently, along with the Inland Group, out of Chicago helped create the DST product for the 1031 space, because we had lots and lots of people, your clients, coming to us that had very, very successful experience with non-market traded REITs, and they would always ask the question, hey, can I 1031 exchange into a REIT? And the answer was always no, because it has to be direct ownership of real estate for direct ownership of real estate. And so it was clear that there was a demand for a REIT-like product in the 1031 space, and that's what DST, then called DBT, Delaware Business Trust, answered. And I think it's our opinion that ultimately everyone ages out of management, but you still like the asset. You're still very comfortable with real estate. You depend on the income stream, and you sure as heck don't want to give a disproportionate amount of your money to the government by way of capital gains tax. You just want something that better reflects a more passive or retired lifestyle, and that's when you start looking for something like DST. So quite apart from being the dark side, I think it's enlightened, because over a period of time, I think in many respects it works better than a speculative stock portfolio for people. And I think you're seeing that. We had a client come in the other day, and because we talked last year about asset bubbles, we've actually been talking about asset bubbles for a long, long time. Even prior to the COVID-19 and the pandemic, we were in a big asset bubble because of a decade worth of free money, and that was intentional on the part of central bankers to inflate asset prices. Well, they did a great job doing that, overinflating asset prices, and then along comes COVID-19 with another $4 or $5 trillion worth of stimulation, and so now you're in this super bubble, and the bubble is clearly losing air. And that's a polite term.
So let's take a quick break here. We're going to talk about the bubble losing air. We're also going to talk. You talked briefly about the non-traded REITs. So we'll talk a little bit about UPREITs. I want to talk about interest rates and free money, and a few other things. So don't go away. David Moore with Equity Advantage and Robert Smith, Peregrine Private Capital. We'll be right back. Thank you.